FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You're listening to the Financial Survival Network. It's Kerry, Lutz. And, well, you knew about hope and change, but there's a thing called buy and hope, which isn't working out too well for a lot of people, or we should say it's going to come up red shortly for those who are adhering to that philosophy. And those are the words of you, Danielle Park from jugglingdynamite.com. And welcome. Always great to have you on.
Hey, Kerry. Nice to be here.
Yeah. So buy and hope. How do you define that? And what's wrong with it?
Well, as you know, buy and hold is this whole, trance-like mantra that's handed out by the financial industry to people who they just want to keep selling product to people and not worry about price cycle or valuation or, probability of success and return. They just want you to be this unquestioning recipient of all things. They want to flow downhill to you. And so they sell to the public that they ought not try to time anything or be worried about when they're putting money into security markets because, it can't be timed is the one thing they say. Nothing can be timed. And also, trying is a fool's game and all this nonsense. And
yes.
The truth of the matter is that it's the opposite of that, right? The truth is that it matters where you are in a market cycle, in a valuation cycle. Probabilities matter. If you take a high risk, low probability of return shot, you're more likely to lose your money than you are to make any gains from it. Mm-hmm. And so you have to be counter-cyclical in what you're doing. You have to be concerned about, whether you're putting it in when the odds favor success or not.
Right.
That it being your hard saved capital. So in Canada, for example, and I show that in the second chart in that series, the TSX has, was at a peak in the first half of 2008 with the commodities boom, and then collapsed into March of 2009 with the rest of the world, and the S&P at the same time fell pretty much in lockstep with the S&P, lost about the same, more than 50%, as it did in the 2001 collapse, by the way. The 2000 to 2000 Feb 03 was when the TSX finally bottomed in the cycle. Right. Prior to that. And we didn't enter official recession, by the way, which is interesting to note, but we still lost over 50% in the stock market in Canada. And so we did the same in the 07-09 cycle. Then it took us the next, all the way into 2014 before we even recovered the losses people had endured in that down cycle. So they spent 6 years, if they didn't bail out, which most did out of the stress of it and the revulsion, and I can't blame them. If you lose a ton, it's not easy to sit for 6 years just to get back to square. Uh-huh. But that's what the industry kept telling people to do. And the ones that didn't panic and stuck with it, got an A for effort, but they also got 6 years of going nowhere just to get their capital back. And then the little green flex there shows, where we traded above that breakout point for a few months in late 2014. And then we're now back to where the TSX was in 2006. So this just goes to show there's a few things that are really important here. The other thing is that the people are 6, 7, 8 years older than they were in the last massive downturn. And so they even have less time now. If we're going back into the next cyclical decline where they're going to lose a bunch of capital and spend a few more years just trying to get back to square, then they're now, way older than they were at the start in 2000 when the secular bear first began. So people have no time for this kind of approach. And because valuations started so rich in 2000, we knew that it would be 18 to 20 years. Probably historically, that's typical of this kind of sideways action where you lose a ton, you spend years making it back, you barely break even, you lose a ton, you spend, and it's just a nightmare. So that's the kind of climate where I've been vehemently opposed to this idea of passively plopping money in and letting it ride up and ride down. We will come to the point where it's a secular boom again, and that kind of a strategy will make more sense. But it sure as hell is not at the valuations that we're at today. We have a lot of downside work yet to go, and we started into it in 11, as you know, but then the QEs really, rejigged the whole thing for a couple more years. But I think we're finally at the end of that. So it's just if you look at the S&P on the QE, the last QE rendition, you got that pop. You got a breakthrough in the U.S. stock market in 2013 that broke through the prior '07 peak. So you've had a little patch of green there, but in the mean reversion phase, that'll disappear very quickly. So the same thing holds. Since 2007, people have made very, very little gains for a whole lot of hardship and anxiety and worry and all sorts of nasty things.
Yeah, a lot of nasty things and a lot of risk. And I thought one of the best points you raised in that article, and it goes back to like Ben Graham, who said you could have the finest security in the world, great run company, wonderful company, profitable, blah, blah, blah. But when it hits a certain price, it's no longer an investment. It becomes a speculation. Where is the world in rediscovering the values of Benjamin Graham, Dodd-Graham securities analysis? I mean, do you think that concept has died of that, you could have Apple at 100, it's a really great stock and, undervalued perhaps. And then at 1,000, it becomes speculative. The world doesn't seem to work that way anymore, or their perceptions don't. Are we going back to the days when it will work that way again, Danielle?
Actually, you're right. Ben Graham made that famous quote, never delude yourself into thinking you're investing when you're speculating. Yeah. There's a fundamental difference, right? Mm-hmm. And the whole industry, because the valuations have become so unhinged over the past 15 years with all the monetary intervention and letting banks go crazy, letting algos trade, unfettered leverage, taking all the lines off the road, because everything went so nut job. Basically, everyone got into this speculative fever. And since the industry, as I said, only wants people to buy and never question, they just started calling speculating investing. And it's become this whole thematic preoccupation to try and convince people that fundamentals don't matter, that CFA calculations are now irrelevant, that it's all about momentum and liquidity, and that's all you need. But unfortunately, it isn't. It isn't, because it can look smart for a little while and then it's fatal. And as I said, how many people can withstand fatal financial blows every 5 or 6 years where they are decimated, and the answer is very few indeed. So I figured out a long time ago that people's risk tolerance is a fraction of what they think. And you find that out very quickly when things begin to lose money. When securities begin to fall, people have a panicked reaction. And in some cases for good reason, because they're over-levered, because they don't really have the money that they've speculated. In fact, they've borrowed to do it. They're living beyond their means, spending too much, all that. So they have a weak financial foundation to begin with. And then you throw whatever savings or money they have scraped up into a quote investment pile, and you toss it into assets that drop like stones. Of course, it has a catastrophic effect on people. So, it's not that fundamentals don't matter anymore, Kerry. They do. They will. They're the great equalizer. We always go back to things that matter. It's like companies that become insanely levered. They maybe look genius for a short period of time. Maybe it's a few years, but then they implode in a spectacular fashion. And so you can't ever know in advance when exactly that tipping point will come, but you're pretty confident that it will. And I think that's the best that we can do, is to keep our wits about us and understand that, that huge leverage that looks so genius at the top is actually the undoing of itself.
Well, we can only hope that people will get wiser, but it just seems like you keep making the same mistakes over and over again and expecting a different outcome. I've done it myself. I'm totally guilty of what you're talking about, getting in close to the high and then getting out at the bottom. I have a knack for doing it. And because, and I don't consider myself a savvy investor like maybe many people do, but I know that my best investments have been things that I've invested in myself, in learning skills, businesses I've done the best in, and also, in markets close by that I have a better understanding of.
Absolutely. Well, on a macro level, the same mistake was made about China, right? People looked at the population itself and said that there's a mind-boggling number of humans there. Therefore, that must be a great place to invest. And in the infancy of that notion, back in when China joined the World Trade Organization in 2001, yes, there was low valuations, there was untapped markets, there was a whole bunch of investor capital just waiting to flood in. And of course, that's when the fundamentals actually line up with the investment thesis, right? It makes some sense. But as time goes on and so much flows in and so much optimism is priced in, it's no longer a good investment thesis. People are still there, absolutely. The argument for why the population is what it is fine. But it's interesting too. How much I like Tesla, and we've disagreed on this in the past, but I think that it's a fundamental leader in the world today. But I don't own Tesla stock. I don't own Tesla stock just because I love Tesla cars, okay? Right. Because I'm trained as a fundamental analyst, and so I have to care about whether the math makes sense as an investment, not just as a dream that you fall in love with. And I think that's the fundamental difference. So I can be a long-term optimist and think that the world is going to continue, or think that equity markets will hit a secular boom phase again someday and go up for 17 to 20 years. But that doesn't mean I have to have my dollars in them right today at current levels.
Yeah, exactly. I think that's a great point. I mean, I agree with the vision there and the dream, but it's a long, hard fight to get there. And think about how many automobile manufacturers there were in the early 1900s, all jumping on the bandwagon of, hey, the automobile, everybody's going to have one day. And, think about the concept for going from the horse to the horseless carriage. I mean, that is an amazing thing. That's way bigger, I think, than going from a car with a driver to a driverless car, because cars have been getting more and more technologically sophisticated. That's kind of an evolutionary thing. It will have revolutionary impacts on society, but
I think it's literally akin to what you've just mentioned there, the horseless carriage innovation that started the whole motor car phenomenon. I think we are at a turning point like that today with technology in vehicles, because it's all about increasing productivity. That's what gives humanity a leap start, a big breakthrough in productivity, which we got from computers and the internet at the late 90s, and which we're getting again today. The whole evolution that's happening right now in vehicles, they are turning into this tech savvy, out of Silicon Valley, not out of traditional places where car manufacturers were made. We're going to driverless cars. We're going to electric platforms. We're going back to the days when car companies are carriage makers, and they are just, everyone's got the same horse essentially, and this horse will be this electric engine driven by battery power and different forms of that. But ultimately, the manufacturing prowess or differentiation will come from how that carriage is put together, what it looks like, what safety features, what interface it has. If you hear Steve Jobs from Apple talk right now about why he's excited about car industry, he says he wants to have this Apple experience when you get into a car where you're interfacing with the world while you're traveling through it. Yeah. So this is, I think there's going to be efficiencies in energy savings, in less pollution, in people's ability to work and rest and relax much more than they can today. I was telling you, Kerry, last weekend we drove into New York City.
That was relaxing, wasn't it? Wasn't that a relaxing trip?
Hell. It took us 3 hours to get across the Brooklyn Bridge into Queens. I mean, it was hell. And if you could drive a driverless...
Technically, but we'll let you go on that.
Anyways, it was hell. So I'm just saying it was unsafe. It was raining out. There was crazy people all over the place. There's going to be less injury in this brave new world. There's going to be less people. The level of intoxication and distraction of drivers is not going to impact people in the same way as it has. So I think this is a huge leap, and it's very exciting.
Yeah, well, it's going to be hell for the personal injury lawyers, but that's a good thing in my opinion. It's going to be a real drought. They're going to have to go out there finding injuries elsewhere, because we have these ambulance chasers down in South Florida that basically run the show. There's billboards up there. They better hope that there's a lot of car accidents before the electric car takes over so they can work off the inventory of cases, Danielle. But, what you say about electric is definitely true. I mean, you don't have a transmission in an electric vehicle. You have hundreds, if not thousands, less moving parts. You got regenerative braking, which helps prolong the charge. And, we're just like really one or a couple of steps off for battery technology that will have 500 to 1,000 mile charges. And
a lot of savings to households, which is exactly what we need to get through this deleveraging, is that the savings to households. So,
well, it's not a bright future for the petroleum industry, but there is a transition period. This isn't just going to happen in one day because, well, at the present time, there's a limit to how many vehicles can be produced in a year. Even if every company in the world was putting out driverless electric vehicles, what are you going to get? 30, 40, 70 million cars a year, maybe, with because it's getting more modular and platform independent. Maybe you'll be able to increase that number, but there is going to be a transition period because US 16 million cars, China 20 something million in a year, Europe throw in another 17, 18 million. There's just constraints, manufacturing constraints at the present time to the transition, but they could be, if it really goes at one point, maybe we'll see the manufacturing capacity double or triple. But right now there is a limit to how many can be produced. And let's face it, the primary means of propelling vehicles is petroleum based at present, but the transition is definitely, you can see the handwriting on the wall. It's going to take place.
You need a new growth push in the world, right? We just changed governments in Canada last night, Kerry, as you may have caught. And this is this theme worldwide where antiquated commodity-based economies and currencies are in a massive downturn. And it's sending the need for change. People don't change typically unless they're forced to change. And I'm suggesting that there's a force for change right now in the world. People can't keep up with the old models because they are no longer mathematically sound. They weren't actually mathematically sound for quite a long time, but because of the credit bubble, they were able to be propelled longer than they should have. But now that the credit bubble is bursting, and also you have this downturn in the commodity sector, you have emerging markets all weakened and left with crushing levels of debt. So you need a new push. And I think that's where the necessity meets the running out of other options. And that's typically when you get this marriage of rebirth of smart ideas and technologies. So I think it's coming at exactly the right time. Here's a question for you, Kerry. I'm just wondering if you knew this. What's the number one stock in the Dow 30, or the largest concentration in the Dow 30? This says a lot about what we're talking about.
Highest concentration, you mean most widely held by investors?
The top percentage weight in the index. What company do you think it is?
It's got to be, well, Apple is not in the Dow, so it's not that. So it's got to be Exxon or Walmart, I would think.
Good guesses, but the answer is Goldman Sachs. Goldman Sachs is 7% of the weight.
You just ruined my lunch.
Well, there you go. So this is what I'm talking about. This old antiquated model we've been through, where leverage and extractors and people who add no value, just take zeros out, are the head honcho in this environment. IBM, by the way, is number 2. And IBM just had a crushing revenue projection going forward, because it too is in an antiquated sort of a pattern of products, which they're like pumping out SUVs at a time when people want Teslas, kind of thing, is the technological comparison to what's going on there. So I think in this next wave, we're going to have, those extractive industries that don't add but take out, zeros to a few, will have to get broken up, taken out, start to demise, as many of them are already doing. McDonald's is also, for example.
Oh, yeah. Did you see that article about McDonald's? That was distressing there.
No, I didn't. Well, I've seen many distressing things about McDonald's over the years, but not this particular article, probably.
30% reportedly of the franchisees in the U.S., this article said it, there's no attribution, I can't verify it, but we know that some of it's true. 30% of the franchisees are insolvent. They're closing 700 stores. Now, I remember when 10, 15 years ago, no McDonald's franchisee had ever closed up. None of them had ever gone out of business. And getting a McDonald's franchise was like getting a lottery ticket. It was your key to the good life. And if you had multiple franchises, I mean, I had a friend in Westchester County where I lived. He owned 12 or 15 of them, him and his father together. And it was very political how you got the franchise. You had to really kowtow to the headquarters in Chicago. And, you know, now it's what the article said, and I don't necessarily buy it, but that it's a dying brand. I think it's
on its way out. I think that's what happens at these turning points, these inflection points where the old models no longer serve. They've basically destroyed they've weakened the host to the point where they can no longer be sustained. And I think that goes for the finance sector that has taken things out, the fossil fuel industry that has been extracting and taking all sorts of value out of. We're at a point where that we can't afford to give that value up anymore. We have to reinvest in things that are more sustainable. And I think the finance sector is another one. We can't afford the vampire squid to be raping and pillaging everything and everyone.
You're so cruel.
We can't have people ingesting food that's killing them, I mean, we can, but it's market forces that are doing this, because people literally get to a point where their health is so emaciated that they say, okay, either I'm going to die or I'm going to figure out a way to be a bit healthier here. And I think that pendulum swings back. So that's why I'm pretty optimistic that these things are going in the right direction. But it doesn't mean, as I say, that you buy into any of this as an investment thesis today. Kind of have to let some of this change happen, the zeros come off, the deflation take hold, and then you get, great investment opportunities.
Well, okay. Some of these things, what we've done to ourselves. A friend of mine works in a hospital, and exactly what we've talked about numerous times, that most ailments that the elderly suffer are lifestyle based due to weight, diet, lack of exercise, lack of mental stimulation, which is crucial, and all these things that really burden society. 80% of the medical expenditures are unnecessary and or not unnecessary, are avoidable. Correct. Okay, by lifestyle changes. And I mean, I admit I'm not always a rational person, but when you get to the point where you're confronted with either you got to control your diet, lose weight, lead a healthier lifestyle, or your health is going to go to the pits, I think it's time to make a change. But it's so hard for many of us to do. And it took me, a real come to Jesus moment to really accept the changes were necessary and that I wasn't doing the right thing. But I agree with you that I think we're getting to the point where we're going to have to become enlightened, because if we don't, we're going to perish. And hopefully this podcast has made you all more enlightened about trends that are going on. Make sure you take a look at Danielle's site, Juggling Dynamite, and read that article that's in there today. Just an incredible article that really brings home the whole issue of risk to you and how important it is in making your decisions, because the powers that be want you to ignore risk while they're increasing it exponentially. You have to be acutely aware of it, which is what Danielle helps do, make you aware of it. So go check out jugglingdynamite.com. You'll find the link on financialsurvivalnetwork.com. Danielle, we'll talk to you in a couple of weeks.
Thank you, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.